Bank of America coughs up millions, and the Fed is eyeing the weakest link. You're in the right place, folks, because this is where the money is. Welcome to the show. It is Monday. Welcome back from the Thanksgiving holiday. I'm Matt Koppenheffer. This here is David Hanson. David, I'm hearing that Amazon wants to use drones to deliver packages. That's great. But what I want to know from you is, what is the next iteration? What is the next big thing out of Amazon? That's already old news.
The drones are pretty crazy. You got to watch the video of these things. They're insane. They got 8 little helicopter things. The next thing that's coming, it's like they just read your mind and know what you want. You don't even have to order anything on Amazon anymore. You're just like, oh, man,
you don't even have to go to the website.
I really want that toaster, and then you turn around and the toaster's there. That's what's next.
You want a toaster?
I need a toaster.
I will get you a toaster. For that.
You.
That's going to be your Christmas present.
Thank you.
All right, getting to the headlines. Now that we know David's Christmas present from me, we got Bloomberg here. B of A reaches $404 million mortgage deal with Freddie Mac. As the headline states, this is a $404 million deal. This settles the mortgage complaints of Freddie Mac between 2000 and 2009 from Bank of America. And Bank of America is the key there. This is only Bank of America. Back in early 2011, Bank of America settled with Freddie Mac for the countrywide claims. And we've said time and again on this show how big of a difference it is between what happened at Bank of America versus what happened at Countrywide, which Bank of America bought. The settlement for Countrywide was $1.28 billion with Freddie Mac alone. And so you got that $1.28 billion compared to this $404 million deal. Once again, Bank of America, bad. Did some bad things, but not that bad. The Countrywide, it was just so bad.
And this lawsuit, or this settlement, was for reps and warranties, basically saying that Bank of America made loans, they said they were good, they sold them to Freddie Mac. Turns out Freddie Mac says, hey, those weren't good, you need to buy those back. So this isn't comparable to the JP Morgan $13 billion settlement. Don't look at the $400 million and say, how is that so much lower?
I have a problem with that $13 billion, not to sidetrack us here, but everybody talks about the $13 billion. It's
a bunch of stuff.
Yeah, it's the kitchen sink is in there.
Right.
Sorry, go ahead.
But yeah, it's not directly comparable to JP Morgan. Don't look at this and saying, wow, Bank of America is getting an awesome deal.
Right.
That litigation is still outstanding, and that involves mortgage-backed securities that Bank of America sold to the GSE. So that is still outstanding. This is not over yet.
Bank of America done with litigation and lawsuits?
No. But with the reps and warranties,
No.
With the reps and warranties, this pretty much wraps up that part of the lawsuit. We still have the other stuff outstanding.
Next headline.
All right, next headline, going to the Wall Street Journal. Oh, we're going to the Financial Times. This one is, Bank of Bird in Hand takes to the skies. Now, this is the first new bank to be launched in the U.S. in nearly 3 years, and it's aiming at an interesting demographic, the heart of Pennsylvania Dutch country. So the Amish investors here.
From the article, they say Bank of Bird in Hand, backed by Amish investors and based in Lancaster County in the heart of Pennsylvania's Dutch country, is opening after raising $17 million in capital. Now, this is obviously a very, very small bank. It's the first de novo bank since 2010. We haven't seen a lot of these, and as the article points out, a lot of it is because it's really hard for banks to operate profitably right now with interest rates as low as they are.
Right, and when we say de novo, that's basically, I guess it's an industry term, but
brand new.
Yeah, brand new. Yeah. Brand new bank coming out of the ground.
Grand opening.
Yes, very exciting.
What I find interesting about the Bird in Hand story is, and this is another quote from the article, it says,
the name?
Besides the name, Bank of Bird in Hand serves a niche market in a geographically limited area. And I think that's the key here. And I'm not gonna go out on a limb and
there you go. I see you did.
I'm not gonna go out on a limb and predict whether Bird in Hand will be successful or not. A lot of that's gonna be contingent on management and who they're lending to and whatnot. But the key here is that they have a target audience, and when we think about competitive advantages for banks, that's a key one, is knowing the demographic that you're going to serve, having a customer base that's going to come back to you again and again.
Yeah, I mean, if you just take a step back in the industry as a whole, it's encouraging that a bank was started. We can leave it at that. It's encouraging for the industry as a whole that people still think there's opportunity.
You want to discount everything else that I just said, all that great stuff I just gave our viewers about competitive advantage.
Everything you say.
You just weren't listening. If you were listening, you would have known how great that was. Final headline of the day. we've got Fed Eyes Financial Systems weak link. And that weak link, David, is?
Repo lending. Very exciting. And this was the stuff that you could argue brought down Lehman Brothers, relying too much on short-term lending, almost overnight lending. And when we talk about repo, it's secured lending, so there's securities that are kind of serving as collateral there. But the worry is when those start to go down in value, things can freeze up, and this can really hurt the banking system and the financial system as a whole. That's exactly what we saw in 2008. The Fed is trying to figure out ways to make us less dependent on this short-term funding. They don't have a clear plan in place, but in this article, they're talking more about the big banks and how they rely on the repo funding.
So I apologize to our viewers here that I don't have a table. Our listeners, I guess, won't care one way or the other. But back in 2008, the final quarterly report from Lehman Brothers, if we're thinking about Lehman Brothers as the benchmark for overuse of short-term funding and short-term lending, 27% of Lehman Brothers assets were in repo loans. 21% of Lehman Brothers liabilities, so their borrowing, was through short-term repo lines. For the banks, they kind of lump a few different things in there, but most of what I'm accounting for here involves the repos. So back in 2008, Bank of America, 4.5%, so about 5% of assets, repo loans. Almost 13% of funding was through repo loans, so 5%, 13%. Citigroup, about 10% of assets, 11% of liabilities. JP Morgan, just over 9% of assets, just under 10% of liabilities. Wells Fargo, a little bit more opaque, so the assets weren't quite as clear, about 9% of liabilities. Again, that's all back in 2008.
It's all pretty similar.
2008. Relatively similar. JP Morgan on the lower side versus Bank of America and Citigroup. Again, we can look back and remember that JP Morgan didn't run into nearly the problems. Obviously, Wells Fargo, the lowest of the group. The most recent quarter, Bank of America, 10% of assets in repo loans, about 12% of liabilities. Citigroup, 14.4% and almost 13%. JP Morgan, 9.6%, 9.7% assets, liabilities. Finally, Wells Fargo, 12% of assets, 4% of liabilities. So putting this all together, I think one of the takeaways is that in some cases, in most cases here, it's pretty similar between 2008 and today with these big banks. Bank of America's assets, the amount of lending that it's doing on the repo side has gone up. Maybe not all that surprising because you fold in Merrill Lynch there.
Yep.
JP Morgan, interestingly, still much lower than Bank of America and Citigroup, and very similar to where it was at in 2008. I think a lot of people think of JP Morgan as a riskier bank. This is one way in which it doesn't look riskier than the other two. And one of the things that I think is particularly notable is that across the board we're seeing a little bit less funding, so a little bit less of the liabilities coming from these repo lines, the short-term lines, but a little bit more lending,
right.
So offering more credit through these, and I know that you've got a point there that kind of dovetails with that.
Yeah, and one of the other industries that we talk about that is getting the lending there are the mortgage REITs out there, and the agency mortgage REITs use a lot of leverage, and that leverage is short-term repo funding. And that can be scary if that market freezes up. That can be a problem, but one of the reasons that it's less scary is that the collateral that the banks are accepting there are usually agency mortgage-backed securities that are pretty safe securities. They're essentially U.S. government debt there. Or for mortgage REITs like Annaly, like American Capital Agency, that do almost exclusively agency mortgage-backed securities, they use that type of funding. But it's risky, but it's not crazy risky. They're not putting up collateral that's completely opaque, that no one knows what it's worth.
Sure. All right, moving on to our focus for today. We're sort of at the end of earnings season, and that also means that we're basically at the end of 13F reporting season.
We're almost to the fourth quarter of earnings season. I mean, it turns over so fast.
Yeah.
One more month.
These quarters grow up so quickly. 13F, for those that aren't familiar with 13F reporting season, all of the financial companies that own stocks, or thinking about mutual funds, thinking about hedge funds, and then companies like Berkshire Hathaway and Markel that own a lot of securities. Well, I guess we could say insurance companies. Both of those are insurance companies that own securities. They have to report in these 13F filings to the SEC, letting the SEC and letting investors know what are the stocks that they own. So this is a great time for investors to tune into these and see what some what the talented investors out there are doing. Not necessarily to just go and copy what a Tom Gaynor at Markel is doing or what Buffett's doing over at Berkshire, but to tune in and then to see what they're doing and then maybe do some more analysis on your own and figure out if that's a good idea for your own portfolio. So I know you've got a few that you were looking at. I've got a few here that I was looking at, so maybe we'll do a little back and forth here. I'll start out with Berkshire because we can't not cover Berkshire. I'm sure that most Buffett fans have already heard what Berkshire's done this quarter, but added a position in ExxonMobil. This has been a position that that the company's been building for a while. This is a Buffett position. They don't really say specifically what's a Buffett position, this is a Buffett position. ExxonMobil, on the other side of the coin, eliminated stock in ConocoPhillips. So this is an interesting kind of pairs trade. If you're looking at the two, sell ConocoPhillips, buy ExxonMobil.
Pairs trade.
Pairs, yeah, you didn't know that I was a short-term trader. Yeah, I know. CNBC is going to be calling me for fast money now. Also added to the very large position in DaVita. This is not a Buffett position, almost assuredly. Most likely this is from Ted Wexler. This was a very large position in his hedge fund before he came over to work at Berkshire. Also sold a bunch of stock in Tesco, the overseas grocery giant.
There you go. One of the ones that I like to take a look at, there's not a ton of quarterly moves in this one, and that's Fairholme Capital Management. That's Bruce Berkowitz. It's really just more interesting to see how concentrated this portfolio is. 65% of the portfolio in AIG and Bank of America. So just a very unique perspective there. This isn't maybe one to go in, like you said, and blindly follow, say, oh, he's doing that, I'm going to put 65% of my portfolio in there. But he's got a very interesting strategy in terms of how he sees value. So I think it's an interesting one to pull up and kind of see where does his portfolio sit? What is he thinking about the market right now? So that's one that's always on my list.
Well, Fairholme was the #2 on my list. I mean, it's makes sense that it's on our radar because of the big positions there. During the quarter, added a whole bunch more Fannie Mae and Freddie Mac preferred shares. And I know there was some talk early on that when Berkowitz was buying the preferred shares of Fannie Mae and Freddie Mac that he also bought some common shares. He did, and then sold them. This is almost as far as I could tell, almost exclusively now a bet on the preferred shares of Fannie Mae and Freddie Mac. And we actually saw the proposal that Berkowitz made to kind of roll those over into a new company. Also added some more Sears holdings. Sold a little bit of AIG and Bank of America, maybe not too surprising given the overweighting in there. Maybe making some room for that big Fannie Mae and Freddie Mac preferred play.
My next one?
Yeah, go for it.
All right, you mentioned it when
when
we kicked off, and that's Markel and Tom Gaynor, who's managing that portfolio over there. And this is an interesting one contrasted to Fairholme. It's much more diversified, a lot of stocks in this portfolio. And there is some concentration at the top. 20% of the portfolio is in Berkshire Hathaway. This is total here. 20% is in Berkshire, Brookfield Asset Management, and Fairfax Financial Holdings. So there's some concentration in there, but it's a little bit different because all three of those companies are diversified in their own right. We talk about Berkshire Hathaway. It's essentially an index fund, kind of. It spans multiple areas of the economy.
Or at least a mutual fund.
So 20% of the Markel portfolio in there is in those three holdings, but those are very diversified as well. So Gaynor, a very interesting one. He's a value guy, but he's also not afraid to invest in some growth companies. He's not a cigarette butt or a cigar butt type investor there.
Or cigarette.
He's kind of
He's not picking things up off the street.
Nobody likes to do that.
Nobody does. Gross.
I don't know if he would brand himself that, but he's a little bit of a foolish investor, so it'll be interesting to see kind of what he's holding. And other than Berkshire Hathaway, his next biggest holding is CarMax there. So maybe just one to look into and read up more.
A lot of buybacks there at CarMax. Big into the buybacks. My final one, this is Manish Pabrai, his funds. Not much to report here. No changes in the portfolio. That's not too surprising if you're familiar with Manish Pabrai. Again, a very concentrated portfolio here, even more concentrated maybe than Fairholme. And he just doesn't do a lot of trading. Picks his positions and holds them, looks for big movements. Among the top holdings, this goes to you and me. Apparently, either Pabrai has been listening to our show, or maybe we've been telecommunicating. I was struggling with that word. I don't even know if that's the right word.
It's probably not.
Got some Star Trek thing going on with Manish Pabrai. Bank of America, Citigroup, and Goldman Sachs, all among Pabrai's top holdings.
All right, my last one, I'll say it quick, is Baupost Group, Seth Klarman.
Oh, good one.
The guy's a genius, so one to put on your radar. There you go.
That's all I gotta say. That's all I have to say.
Also a very concentrated portfolio at the top there, so one to check out. And you can find these on SEC's website, but there's also a website that's pretty easy to navigate. It's called whalewisdom.com. It's another easy one to just go in and check some stuff out. So there you go.
Thanks for that enlightening report on
You're welcome.
Klarman. All right. Let's head over to the mailbag. We've got an email address for all of our viewers and listeners, WTMI@fool.com. We love getting emails, love getting questions and comments and complaints. Today's email, we've got Joe Begley emailing us. I'm a college student studying abroad in China. Nice. And I listen to your podcast every day to keep me updated. You guys are great.
You're great, Joe.
I don't disagree. And yes, Joe, you're great. I'm 20 and I've been mock trading for years. When I get back to the US in 2 weeks, I'm going to manage $10,000 of my college fund. I can buy whatever I want. With that amount of money, how do I diversify and be safe while getting upside?
I should say off the top, I'm not sure. He didn't say in his email when he says $10,000 of my college fund. I don't know if that's $10,000 that goes to paying for his college, or his college has some sort of investment fund that they allow their students.
That's a good point.
So that could be different.
I assume the latter.
I would assume the latter too, but if it's actual college fund, I would be maybe a little conservative.
Yeah, I wouldn't.
If you're going to need to spend.
Well, I wouldn't. I'm not even sure that I'd put that into the stock market. If that's money that Joe needs to pay for his college,
which he's in right now.
Yeah, exactly. Generally speaking, and this is something that I say for myself, and I think this is something you hear all over Fooldom. If you need the funds within the next 5 years, really not the best idea to put into the stock market, because it's tough to say when the next downturn is going to be, and otherwise you're kind of timing the market.
Yeah, so we'll assume it's fund. So did you have any quick thoughts on that?
Well, it really depends on what type of investor and what comfort levels you have, and what you're trying to achieve with what you're investing. I mean, a retiree is going to have a much different outlook on this than somebody else. Personally, I don't like having a very broad, wide diversification in my stock investments, in my individual stock investments. I know somebody had mentioned one time in an email to us that it looks like I own a ton of different stocks as listed on Motley Fool. But the concentration of where I have the money in those stocks is a lot more concentrated than what it looks like. With $10,000, I would probably not go further than 10 stocks, personally. Mm-hmm. I think going beyond that, you're probably over-diversified, and particularly if you're going to end up paying any sort of trading fees on that, you're going to get eaten up a little bit by fees, just going in any smaller increments of $1,000 a piece. And I think 10 different stocks gives you ample opportunity to diversify across there.
Yeah, and we mentioned just in our last segment how Markel owns stocks that are kind of diversified in their own right. If you look at Berkshire Hathaway, Brookfield, Fairfax, those are all big companies that are in multiple areas. So they're individual stocks, but you're getting diversified within those companies. So maybe those are the type of companies that Joe might want to look into.
On the low side, I think five stocks might be reasonable with that kind of size of a portfolio. And again, depends on the trading commissions that you have to pay. If you don't have to pay trading commissions, you have a little bit more of leeway there, because you set yourself up a higher and higher bar that you have to leap over if you're paying trading commissions on smaller position sizes. Number one position if you were investing a college fund right now. For a college fund, and again, not...
I don't own it, but it would probably be Berkshire.
How do you still not own Berkshire?
Moving on.
Moving on. Jeez. All right, game for today. We've got a little making the grade. Again, with this game, what we do, present a couple scenarios, and then draw our beautiful, wonderful, artistic renderings illustrating our thoughts on the scenario.
All right.
First scenario, selling stocks to book capital losses. David, as we get towards the end of the year, a lot of people sitting on losing positions are thinking about selling them to reap those capital losses for tax time.
All right. For those listening, they're not going to be able to see this, but it kind of looks like a ghost, but it's not. It's a guy shrugging his shoulders there, and he's saying, I'm not sure. And that's my grade. It's not really a grade. It's more of a, it really depends on the situation, and I think you have to look at it at a company basis. You look at the stocks that are down big this year, the mortgage REITs, Armor Residential, American Capital Agency, down big. People might be wondering, should I sell these things and just book the losses? I think if you have another opportunity that you're more comfortable with, you think has better upside, then you should do it. But if not, if you're just selling to book the capital losses, I say, nah, doesn't make sense.
Nah.
What do you think?
These Sharpies are really strong smelling. That's what I think.
That's why my picture's so bad.
Get high on this show. I've just got a question mark here. Maybe it's because it's Monday. I didn't get too creative. Here's the thing. Selling just to book a capital loss, just because you're thinking, oh, I'm down in this position, selling for solely that reason, I don't think is really that great of an idea. Particularly when we're thinking in increments of 5 and 10 years. We want to be holding these stocks for long term if we believe in them. But at the end of the year, if thinking about capital losses gets you to revisit and think about, well, this stock is not doing well, how is the company doing? Do I still believe in it? Then if you settle on the fact that this company really isn't delivering the way I thought it would, I'm going to go ahead and sell it, then that can be a reasonable outcome.
All right. Next scenario.
Next scenario. A bank decides to swear off buybacks and only issues dividends. David, your picture.
We've talked in the past about how buyback can be great if you have a person at the top that's a great capital allocator and does it at the right times. But on the whole, that doesn't happen. So I'm giving this an 8+. The dividend is a little bit safer of a move there. An 8+, yes, I'm combining it. There are times where buybacks are great, but if we look at a bank like New York Community Bank, it's been a beast, just giving out dividends and dividends and dividends, and it kind of puts it on the shareholders to whether to reinvest those. Could have been successful doing buybacks, but most of the time, I'd probably prefer having a dividend than a huge buyback program. What do you say?
Going a little boring again too. Going B-. I'm not as stoked about it as you are. The thing is that I'd like to be invested in a bank or any company that has executives at the top that are good capital allocators. I want to be able to trust that they know what to do with the money that the company is making. And if I have to be really excited about the fact that they're only going to pay dividends because they're too what's the nice
worried to
mess
this?
Up? Yeah, well, that I can't trust them as to when to deploy share buybacks. That's maybe not the company that I want to invest in the first place. But at the same time, the sorry fact is that they usually will screw up buybacks for the most part. So B-.
All right.
I'm okay with it.
Last scenario.
Final scenario. David, your Thanksgiving spread.
My Thanksgiving spread was quite tasty. So this is a picture of me, and I'm sitting down there. My shirt is too small for my body. Belly button is coming out of the shirt. Eyes are X'd out as if I'm dead, but I'm smiling. Very good Thanksgiving. How was yours?
I have. Oh wow, that you explained that way too fast, so I didn't have time. This would have been a work of art. That would have been a Picasso, but I didn't have enough time. That is me. Yep, that is me on the couch snoozing. Those are Z's coming out. Because I ate so much good food. There's this sweet potato casserole with there's coconut in it, some brown sugar, pecans. Oh man, it was
pecans or pecans? What are you? You're a pecan man?
Well, apparently.
All right.
Pecans. Are you trying to correct me now on?
I'm both. I don't know. I haven't decided.
You go either way. Yeah, it was delicious, and then I got to sleep on the couch, doze, watch a little football. Nothing wrong with that.
There you go.
Finishing out Twitter sphere. David, what is our first tweet?
Our first tweet is from Crowd Turtle. He says, "Circle of competence involves the assessing of probabilities more than it involves the deep intricacies of businesses." And we talk about Warren Buffett. His circle of competence, you could say, is the financial sector. And people would say, how does he understand banks? They're so complicated. And I think that tweet hits it right on the head there. It's very hard to understand the intricacies of Bank of America and Citigroup, but Buffett understands the probabilities and the economics of the businesses. So sometimes that's more important than understanding how a CDO squared works and how the bank makes money. So
it's like a question we got last week that was kind of saying, how is it that Buffett could be considered a great investor when he was invested in banks before the financial crisis? And I think that goes A lot to it.
There you go.
Second tweet.
Final tweet.
Final tweet. We've got Wouter Kleefstra, one of our loyal listeners, and here is, he's tweeting at us, at TMF Financials. Good you did not use Bitcoin to buy turkey. Bitcoin over $1,100. You'll be able to buy 1,000 turkeys by next Thanksgiving. First, let me point out, Wouter tweeted at us. We're on Twitter. That's at TMF Financials. David, we had a Thanksgiving special, a
Yes.
Bitcoin Thanksgiving special. Our viewers and listeners can find that online. It's called A Very Bitcoin Thanksgiving.
We tweeted it as well.
We tweeted it as well. Are you glad that we didn't have the opportunity to spend that Bitcoin?
I kind of wish we did spend it and then had a page tracking how much our Thanksgiving dinner cost us. I think that would have been cool. So over like next 10 years, we'd been like, that Thanksgiving actually cost them $1 million. I thought that would have been, maybe we should do that next year.
Well, maybe that's what you think it would have cost us.
Are you glad we didn't?
I don't care one way or the other. I think maybe the turkey will be worth more than Bitcoin 5 years from now.
Well, maybe we'll do something for Christmas, and so we still have our point.
I think we have to do something for Christmas. Maybe we'll get you that toaster.
Oh, thank you.
We'll get you that toaster you've always wanted.
Perfect.
All right, that's our show for today. Like I said, you can tweet us at TMF Financials. You can email us, WTMI@fool.com. That's all we've got. I'm Matt Koppenheffer. This is David Hanson. Thanks for watching. We'll see you tomorrow.
People on the show may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. Don't buy or sell stocks based solely on what you hear.